Hello, from LPL Financial, welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It's Tuesday morning, July 5th, and this is The Talking Point. Thank you for joining me. The futures market this morning, as I do this call, in the red, the 10-year Treasury yield below 3%, and concerns in the market that the economy is slowing faster than initially anticipated. However, we have an important week for the market. And this is a week in the market that can tell us and suggest to us where we may be headed. Number one, we're going to have factory orders this morning. Obviously, that's important. And one of the main reasons it's important is that we have been seeing from the purchasing managers' indexes, those are the PMIs, that orders are down. Not down and contracting yet. I just want to make that clear, but that they're moving in the wrong direction. The factory orders will give us a suggestion of whether or not buyers are coming in, either going towards retail clients, customers, or businesses. It's very important because even though this is a report from May, at this stage, I think there's an acknowledgement that the Fed's interest rate hikes are indeed slowing the economy by design, right? The Fed is doing this by design, thinking that if you can slow down demand, you're going to bring prices down. Hence, inflation will come down. So we'll be watching the factory orders that come out this morning at 10 o'clock Eastern. But tomorrow on Wednesday, we are going to have the purchasing manager indexes, right? For the service sector, there will be two reports. One will come from the S&P Global, and the other one will be from the Institute for Supply Management. We are a service sector economy. And even though we have seen the manufacturing sector report slow, still in, I want to point this out, still in growth territory. 50 is the dividing line, both for the service sector and the manufacturing sector. But in the manufacturing sector, we saw those numbers come down a bit, right? That's the trajectory, but still above 50. That's the headline number. This is the same thing for the service sector, but again, I repeat, we are a service sector economy. So what are we looking for? We're looking for new orders, holding up, climbing higher, and we are looking for hiring expectations to still remain positive. And then there will be another segment, and that will be inventories. And we'll take a look at that. There's a sensitivity towards inventories because if inventories sit, as we know it's happened in the retail sector, correct? That's obviously a clear indication that buyers are not coming in and clearing out that inventory. So this is going to be an important report for the market. And then, of course, we will have on Wednesday the FOMC, that's the Federal Reserve, minutes from the last Federal Reserve meeting. And we'll see if we'll learn anything new. It used to be that you did pick up nuggets of something new, atmospherics. But given the way that Federal Reserve speakers come out right after the Fed meeting finishes, they tell us what they're thinking, and it's quite up to date. So nonetheless, the market will be focused on Wednesday at 2 o'clock Eastern for the release of those minutes. Also, we'll have job openings on Wednesday. That's the ADP report. I want to repeat, it's extremely important. We are getting the labor numbers on Friday. The ADP report just focuses on the private sector. So to say that they have a direct positive correlation with the report that comes out on Friday, the government report, is wrong. But they do give you a trajectory. That's what's important. They give you an idea of where the private sector is in terms of labor, in terms of hiring. And then on Thursday, we were going to pay attention. You notice that this is becoming more and more important, and that is on the jobless claims. And the reason that this is becoming more important is this. As the Fed raises rates, is it going to lead to more layoffs? Is it going to lead? We know that there are hiring freezes, but we want to know if there are more layoffs. And the other part of this story is where, the bad news becomes good news. You've heard that over the years. Bad news is really good news for the market. And this is that if there are fewer job openings, and we're also going to have a report on that this week too, but if there are fewer job openings, it means that labor basically can't go in there and demand higher wages. That's something that the Fed would like to see because they don't want to see wages continuing to climb and adding to the inflation spiral. In other words, companies, small business owners, large business owners say, well, we have to hire people. They're demanding higher wages. That means we have to raise the prices. And if we raise the prices, we've got to pass along those higher prices to, guess what, to us, the consumer. So either the businesses that are buying goods and services or us. Ultimately, it always comes down to the U.S. consumer paying for higher prices, paying for everything. And the question really is, if there are fewer openings and if we see layoffs picking up, perhaps, again, new job applicants don't push for higher wages. They're just happy to get a job. This is something that has been, how shall I say, underscored by a number of Fed speakers, that this could help the Fed get closer to bringing inflation down, to corralling it, to curtailing inflation. So the market will have yet another reason to pay very close attention to the numbers regarding the labor report that comes out on Friday. So we're going to be paying attention to unemployment rate. Expectations are that the unemployment rate remains the same at 3.6%, but also average hourly earnings. Obviously, they've been moving higher. We want to see that pulling back. And I want to just mention, too, how difficult this is to discuss, because as prices rise at the pump, rents, for example, food, you know what? You want to see the worker get more higher wages, right? Do better in order to take care of these higher costs. But when we are looking to fight inflation, and when the market, notice I say the market, is looking for that day when the Fed can claim victory over inflation, that inflation is plateauing, they become less hawkish in their rhetoric, that's a positive day for the market. And so part of that is that we see hourly wages come down. So it's an extremely busy week for the market, but we'll be paying attention in the equity market. We'll also be paying attention to the Treasury market and looking at those yields, because the way that it's working is money is being allocated towards, because when yields come down, obviously it means buyers are coming in to the Treasury market again. But the question for the market is always this: are we seeing the 10-year Treasury yields come down because everyone seems to expect that the economy is going to continue to slow, and perhaps slow dramatically? And that's a debate in the market. In addition to all of this, right, the other thing we're waiting for this week and next week is the pre-announcements and perhaps earnings revisions in the opening of the unofficial opening of the second quarter earnings season. This is going to be important because right now we are seeing the revisions ticking back up. Some of them are favorable, some of them are negative. But what we want to see overall is a realistic picture of what the market is going to expect as the earnings season opens. For those of you who are new to the industry, new to this, to looking at markets, remember we're always looking back, right? We're in the third quarter now, and we're looking at second quarter earnings. And the reason is it's that it just finished. But what we're also going to be completely focused on, is the guidance that corporations give us. What are they seeing from their customers? What are they seeing from their clients? Because the market is looking ahead. And when we look ahead, we want to see what kind of picture are the companies going to be giving us. So when the earnings season opens unofficially, right? I say unofficially because we've had earnings come out, right? They've been coming out all along. But the official start of the earnings season comes when the banks give us their numbers. And it's the middle of the month. So a lot of information for the market to absorb at this point. Here's some good news, though. Statistically, yes, historically or statistically, over the last 20 years, the first 2 weeks of the third quarter, which is where we are right now, tend to give us a positive return. It's small, but it's positive. It's just over 2%, 1.5% to 2.5%. So this is important, but that's statistical, it's historical, and we always have changes in the statistics as new data come in. But the market is looking for any hope, any chance that we can end this year in the green. And as you saw over and over again this past weekend, this is the biggest loss in the S&P 500 in many years, since 1970 for the first half of the year. And we look to 1970 because they made up tremendous ground in the second half of the year, closing in the green, just barely, but closing in the green. But this is what the market wants to see, and the way that we're going to be able to figure out whether or not we are going to close in the green for the year will ultimately come from earnings and what companies are seeing. And this is why there is such a fixation right now on whether or not the Federal Reserve is going to go ahead with the 75 basis point rate hike at their meeting at the end of July, and the effect it will have on the economy and on revenue growth for companies and their operating margins. So there's an awful lot for this market to deal with. But to cut to the chase, to make it as simple as possible, what this market is looking for is whether or not inflation is coming down in a meaningful way, and in a way that can have the Fed, again, declare a sort of victory, that it's not necessarily peaking, but plateauing. And then the market predicts then that perhaps the rate hike campaign is going to ease. That's what the market is really looking for this quarter and the next quarter. Right now, the market is still pricing in 75 basis points for the July meeting. Good news. Let's end on good news again, and that is that the Federal Reserve's favorite indicator of inflation, the PCE that came out last week, the personal consumption expenditures, actually in the core pulled back a tad. But you know what? That matters, because if that were to continue over the next number of months, that would mean that the trajectory of inflation is coming down. And by the way, that report was from May. And obviously, as the Fed's interest rate hikes, come into the system, we'll see inflation probably pulling back even more. So the next reading should be even more attractive. And so that's it. We're looking globally right now. We're seeing China coming on board. Their demand for oil is going to move up. While they were locked down, the demand for oil is down. But as the country opens, two pieces of information that we're following is, one, the global supply chain beginning to untangle even at the margin, so that the global supply challenges ease. So that's one thing the market is looking forward to as China opens. The second is, as they open, will we start to see their factories start to bring in the goods and get the goods shipped here to the United States and over to Europe, again, helping to bring down prices, because that's the way it always was, correct? But with the supply chain challenges, it has made supplies more expensive, and hence pushing up inflation. So let's get through this market, and let's hope that on Friday we get a number that gives us still a solid and strong labor market, but with wages beginning to come back, pull back, and with job openings beginning to ease. Because again, fewer job openings means that the supply in the market for people, they can't, again, demand those wages when job openings were, dramatically higher, and fewer people looking for jobs. So that's the story this week. Keep in mind, sometimes in the market, for the market, bad news is actually good news. Take care, have a very good week, and never hesitate to get in touch. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.